Joining us live to unpack what's ahead is 1789 Capital partner Paul Abrahimzadeh, whose firm has invested in another big name in this year's IPO conversation. We're talking about SpaceX. Paul, it's great to see you.
Thanks, Katie. Thanks, Romain. Great to be back.
So let's start exactly there because, capital markets have been open. When you think about IPOs, you also think about M&A, and I wonder, if there's any sort of optimistic takeaway we can glean from that.
There's definitely reasons to be optimistic. We look at the strong GDP print back in Q3 at 4.5%. Look at some of the tailwinds in key sectors in the private market. So I think the reasons to be positive about the outlook for IPOs and the new issue asset class. There are also reasons to take some pause. You've seen a compression in multiples at the high end of the market. Software multiples now mid to high single digits on a one-year forward revenue basis, down about 30% based on AI disruption fears. That impacts a lot of the tech backlog, the high growth IPO backlog. But to put in perspective, the markets are incredibly deep. So I know there are a number of big IPOs that are on the horizon. The average IPO volume in the U.S. is roughly $50 billion per year. At the peak in 2021, it was $150 billion. You've got 3 large potential IPOs this year that could represent a meaningful portion of that annual volume. But put it all in context, the market cap of the U.S. equities is $50 trillion. So there's incredible depth of the market. I think once you see the VIX come out of this 25 to 30 paradigm, which is double the normalized level, we should definitely see a very strong bid for new issues.
Yeah, watching the VIX has certainly also been quite an activity over the past couple of days here. But I am curious what you make of what's going on in private markets right now, because there's a lot of headlines out there, most of them about private credit and some of the redemption requests that you're seeing there. But what are you seeing when it comes to the private company side of things, and how might that potentially affect the pipeline going forward?
The credit markets always move first. They're an important indicator of what to expect on the horizon for equities. So we need to look at that and assess it in terms of risk. The reality is there are some segments of that private credit market that certainly have weakness, although it seems at the moment to be more driven by liquidity needs for the underlying investors as opposed to true systemic weakness across that entire ecosystem. You asked about the private markets. I look at our portfolio at 1789. We have roughly 30 portfolio companies heavily skewed towards AI, software, and defense tech. The reality is it's hard to get a read on valuations for IPOs looking at the current cohort of public tech companies because growth has been brought down so dramatically. There are less than 10 public software companies growing roughly 30%. And you look at the private market, our portfolio, for example, the median revenue growth is 100%. Most of that's at scale. So it's very hard to get a read through on valuations. And I think that's going to be the challenge for bankers bringing companies public over the course of this year is you just don't have really good public comps.
Well, that's what I'm curious about, too, when we talk about some of those companies, particularly some of the ones in your portfolio, and we'll get to SpaceX, which is obviously going to be a no-brainer for a lot of folks. But some of the other ones that you're involved in, there's a lot of questions about, whether they could be disrupted by AI, basically the disruptors becoming the disrupted, but also just this idea of how you articulate what their long-term value is, given that no one really seems to know what the longer-term impact of AI is going to be, good or bad.
Without a doubt. We're doing our absolute best as we analyze these companies to try and assess that multi-year risk, recognizing that while we think a third of our portfolio, so roughly 10 companies, could be public over the next 12 months, many of them will be multi-year holds. And so we have to avoid that disruption risk. We do that by trying to pick the best-in-class winners across each vertical, whether that's in the model layer, the apps layer, AI-enabled software, defense tech, et cetera. But I think by trying to pick the best of the best within those verticals with scaled businesses, commercial-grade revenue, and what we think are highly durable forecasts, you can hopefully avoid some of those pitfalls. Clearly, you're seeing that shake out in public software with that multiple compression that I referred to. And frankly, you're seeing some of the enterprise software companies that have promised agentic solutions but have not yet delivered getting punished the most as it relates to compression on their valuation.
Perplexity is one of your holdings, correct?
It is.
Yeah. And how does that stack up when you sort of think about, some of the things we've seen in publicly play out between OpenAI and Anthropic, obviously some of the issues with the Defense Department, and how does a Perplexity sort of fall into that debate, if at all?
It's a fantastic company. I think it's a very competitive segment. And the reality is each of the companies that are touching the model layer are ensuring that they've got a deep moat.
But Perplexity is kind of across all of those.
It's across all of them. Yeah. And so when you think about application layer, for example, you need to make sure that you aren't incumbent or relying on any single model. But the reality is they've shown really very strong user metrics and very strong user adoption. We've also looked at companies like Reflection AI that we co-led for the Series B. They've put together a fantastic team, and they're really leading the open weight segment to give a counterbalance to the closed weight models that have had these recent issues you've seen in Washington. So many of the governments, whether it's sovereign or enterprise customers, need to control their data. They can't have a commingled cloud. They want to be able to build their own proprietary application layer. And so we think open weight models is really where you're going to see a lot of that focus shift.
I want to take a little bit of a wild card turn here and talk a little bit about special purpose vehicles, because, when you think about 1789, you invested in SpaceX, and there's a lot of people who would like to invest in SpaceX, especially as we get closer to a potential IPO date. Bailey Lipschultz has a great article on the Bloomberg terminal about how there's all these special purpose vehicles that purport to have SpaceX and other holdings as well, some of the other hot potential IPO candidates, and how there's a lot of question marks over whether or not some of these SPVs actually have the holdings, have the relationships with the companies that they say they do. And I'm just curious, given that you are an investor in SpaceX, what you make of some of these different access points that are trying to be created to some of these very hot companies.
It's a great question. 2 points on that. Number one, the best-in-class companies in the late-stage private market run a very controlled cap table. So they're highly aware of distribution of stock and how that works. And so we find those that control their cap table end up having, as long as the company's performing well, very durable valuations because there's no supply of stock in the secondary market. That's point one. Point two, we invest only direct on cap table. So we're very fortunate to have that direct access with the founder relationships, relationships with the board members and the VCs in those companies. And by doing that, we ensure that our LPs have just one layer of fees and have one path to liquidity based on our view at the general partner. There are plenty of SPVs in the market that go back to back through multiple layers. And if you're the end investor, you've got very little control on that position. You can have multiple layers of fees. And it can end up being a very convoluted process to unwind those positions when companies ultimately go public. So I think a key part of Bailey's article is touching upon the fact that there can be overhang in some of these companies post-IPO, post-lockup, because you've got such a broadly distributed shareholder base.
All right. And any insight into what the timing of that IPO might be?
No specific comments, but I think the market will be open once you see volatility come down, greater stability in broader equities and fixed income. There will be a very strong bid for these must-own names. I think we talked about it before. So many of these mega cap companies in the IPO backlog are must-own. They're going to be part of the benchmark very soon after going public. But we think that the market, as soon as we get past this period of volatility, will be open for those biggest companies to access the market.
All right, Paul, really appreciate it. 1789 Capital Partner Paul Abrahimzadeh talking about the opening up here of the IPO market.